On the podcast with us today is Spencer Gray. Spencer, welcome to the podcast.
Hey, thanks, Dan. Appreciate you having me on.
Well, I'm looking forward to diving into this property. You guys acquired this back in December of 2020, 290 units, villas on Fur over in South Bend, Indiana, in Granger, Indiana, over there near the University of Notre Dame. So looking forward to diving into this one. But before we do, why don't you give the listeners a little bit of a background of yourself and where you are right now as far as the multifamily side of things?
Yeah, no, sure thing. So I come from a little bit different background than some, where, most people, they kind of come up, being told to, go to college, get a W-2 job, get a degree. I was raised in a very entrepreneurial family. I watched my parents start a business when I was young. And so really the stress was more on, you need to go out and start a business at some point, not necessarily go get whatever degree. And so I feel very fortunate and blessed, that I come from that type of upbringing. So I've always had the drive to be an entrepreneur. I first wanted to get into the music business. So I went to school for music production, Indiana University, worked as a freelance recording engineer, did a lot of work for audible.com. Really just, it was a passion of mine, but really couldn't make a business out of it. And so I started flipping houses and eventually started another business related to the craft beer industry. We were essentially a broker for hops to craft brewers around the country and started exporting internationally. Sold that business, and really I had been educating myself on buy and hold multifamily investing because I'd been doing flips, but I didn't like the churning and burning and always looking for the next deal. And I wanted to build, long-term wealth. And I really identified multifamily assets as that vehicle. So about 2015, my wife and I started a company, Great Capital. We really just started doing co-GPs with a syndicator locally because we realized we knew a little bit. There was a lot that we didn't know. We were interested in this HUD 223F financing. Our lender said, yeah, it's great, but you're not going to qualify for it. You got to partner with somebody, get some experience. At that time, I didn't even know what a syndication was, but we ended up partnering with a syndicator local to us. We're in Indianapolis, and just started doing co-GPs with them, and eventually just started, bringing in friends and family, and kind of built up our investor base. And then after about 10 co-GPs with that group, we started doing our own deals a little over a year ago.
Well, it's exciting. It's exciting to kind of see that trajectory and that growth. So how many years have you been in the business so far, and how long has Great Capital been around?
So since about 2015 was when we started.
Cool.
I've been investing in real estate since about 2006 or so, but really took it seriously full time in 2015.
That's great. Well, let's dive into this deal that you guys acquired last year. It's definitely a big boy of a deal. So a little over a $61 million purchase price. Is that correct?
That is correct.
Yeah. So talk to us first about how you found this deal. So just to kind of recap real quick, it's 290 units called Villas on Fur, located in South Bend, Indiana. So tell us, how did you end up actually coming across this deal?
Yeah, so this project was through a broker through the Indianapolis branch of Cushman and Wakefield. We had successfully closed on a deal much smaller than that, or much smaller than the $61 million project. It was about an $8 million project. This was back in September when we closed. And so we, had a track record of, working with this broker and closing. And we were interested in the project because the numbers seemed to make sense, at least when we initially underwrote it, especially for the, it's essentially newer construction, had just gotten out of lease up. And for the quality of asset and for the demographics in the market, we said, well, let's at least kick the tires on it. Let's drive up there, take a look. And not knowing that how necessarily we were going to raise the equity for it, put the whole deal together, but, let's get into it, take a look. And so, we went up there, gave it a tour, and, eventually submitted an LOI. And, somehow we were able to win the deal.
Yeah. So when you guys first heard about the deal, how long did it take for you guys to get to the point of going to tour the property?
So the deal had been floated for a while it was still in lease up. They hadn't brought it to market yet because they were basically sitting at 70% occupancy for really about 8 months or so. Even back in June, they were still at 70% occupancy. So we were aware, just having conversations with this broker, because we were working on them with another transaction, that this was coming to market. And so we knew about it, but then once it actually hit the market, we'd probably been aware of it for about a month and a half. But from the time it hit the market and the time when we toured it and put an LOI on it, it was about, I'd say 3 weeks.
3 weeks. Okay. And so how many rounds of offers did you go through? Because obviously when this time of an asset, there's going to be probably 20, 30, maybe 40 people bidding on this thing that are submitting offers. And so you're obviously submitting your first LOI. How many different rounds did you have to go through?
There were three total rounds in a buyer interview after the second round.
Okay. And so once you got into that best and final round, you guys were in the rounds, I guess, to be able to have the buyer calls. When you were in that best and final round, what kind of communications did you have with the broker that could help kind of, potentially guide you to be able to make sure that you guys were awarded the deal?
Yeah, it was interesting because, we were probably the one buyer that had the best relationship with the broker itself. There were some other offers all the offers were essentially at the same purchase price. We were all right in that same ballpark, plus or minus, $100,000 in a deal this size. That doesn't necessarily mean as much as terms and certainty of being able to close. And, the biggest objection that we were hearing from the broker and the way they were guiding us is, really having a good understanding of where our equity was coming from. And at the time, we had an idea of where it may come from, but it wasn't a certainty at all. We had a couple different leads. We had, our own internal network that we had been doing projects with. Then we also had some institutional contacts that we've been having conversations with about the idea of doing a larger deal, but never had actually done that first deal. So a lot of the guidance that the broker was giving us is that, as soon as we can have some certainty on where that equity was coming from, it would really be able to move the needle significantly. And really the only thing that I think that allowed us to be awarded the deal, because by the time that we did get it under contract, we still did not have all the equity figured out, is that we were just very transparent with the broker, with the seller. We told them exactly what we could do, what we were looking to do, the conversations we were having, and told them, we're going to know within 2 weeks whether this is a go or no go. We were already going to be out, significant amount of, deposits that we had already made and, due diligence costs. So we were already, to a sense, committed to the deal, but not to the extent where we were willing to lose an earnest money deposit. So, we basically told them, give us a little bit of time. We want to pursue this deal. We're going to make our best effort, do everything we can, leave no stone unturned, but we're going to be very straight up with you. If we can't proceed, we'll let you know. And I think they appreciated the transparency and honesty. And I think that we were the only buyer that they were really familiar with, and that they at least knew who we were. All the other buyers were out-of-state buyers.
And you guys had also closed another deal, or possibly two, in 2020 during the middle of the pandemic. Is that correct?
Correct. Yeah, we had closed one deal with them, and then another project with another broker. And then we'd also we have a relationship with them from a lot of all the co-GP projects we had done in the past. They're a very active broker here in the Indiana market. So we already had a good relationship going back, several years. So they knew who we were, what we were doing, but certainly as a lead sponsor, this was by far our largest transaction and a big deal for anybody. So.
And again, this goes back to what we talk about on many of these episodes about broker relationships. It's a relationship business, right? We also talk about investor relations, and it's a relationship business. And a lot of times, especially with the acquisition side of things, you have to build those relationships well enough with those brokers, because I can almost guarantee you, Spencer, and you'd probably agree with me on this one, that the only reason why you were awarded this deal is because you had a good broker that was actually pitching you to the seller. Right.
Oh, absolutely. And they exactly. And they told us that, and it honestly put more pressure on us when we were awarded the deal, because they had vouched for us. And not only them, our lender vouched for us, because the buyer called the lender. I mean, they totally, they did a background check on us, really checked us out, and even had some people, and we don't know exactly who, but we had people telling the seller that they were familiar with us, familiar with this particular raise, which I have no idea how they would have known anything about it. But they said, we know Spencer Gray, they're not going to be able to close on this deal. Don't go with them. And so there's somebody in the seller's ear actually, trying to convince them not to award us the deal, where then we had some of the folks that we worked with who were saying, these guys are the legit, give them a chance and see what they can do.
I'll tell you, Spencer, I mean, this is one of those things where when you get a deal like this and you're signing the contract, I call it a butt pucker moment, right? I mean, it's definitely a challenging piece because this is really a make or break. Like if you do this thing and you don't execute, I mean, you're finished,
Exactly. That's what we said internally to our team. I said, this is a binary moment. We are going to be able to do what we said we've done, be successful and execute, or we're not. And we're going to be able to, make our name for ourselves, show that we can do, what we said we're going to do, or we're going to fail. And we're going to have a reputation of succeeding or failing. And everybody, at least locally in the industry, somehow got word that, we were doing the deal. And so, yeah, it was definitely a butt puckering moment for sure of, all right, how are we going to do this? And really became not an option. We have to do it and we've got to figure it out.
Yeah, you'll make a name for yourself one way or another, right?
Yeah, exactly.
Yeah. So now we've got the contract on the deal. We're kind of in that, due diligence process. Anything exciting that happened during the due diligence phase?
I wouldn't say it was too exciting. It was a little bit different. They were actually pushing for us to have an early access period during LOI negotiations before we got under contract, because they wanted to close before the end of the year. We wanted to close before the end of the year also. We didn't want to be closing certainly, just this last week, the week before, between Christmas and New Year's. We wanted to get it done in 2020 so we could have the losses in 2020 and not 2021. And so we were able to get started a little bit quicker than normally, and to get third-party inspectors going, getting everything scheduled. So I guess there was nothing too strange other than we were just moving much quicker than we had in the past, and really just kind of seeing we needed to have as much and as good quality information as soon as possible, because when we had about $500,000 of earnest money that would go hard at the expiration of due diligence, another $500,000 that would go hard after a 15-day financing period after due diligence expired. So we needed to know, before the expiration of due diligence, whether it was a go or a no-go. So we were trying to move as quickly as we could to have that certainty. And the seller also wanted to get a sale done before the end of the year.
Let's talk about that hard money a little bit again. And for those of you who are listening, we're talking about hard money. We're not talking about a hard money loan or anything like that. We're talking about this earnest money deposit that goes hard or is non-refundable at certain points throughout the period, depending on the terms that are initially set for. So was there any hard money that was set out from day one, or was it always after the due diligence period?
It was after due diligence expired. So we had no hard money day one, which made us much more comfortable. And we essentially told them, look, we want to do the deal, but we were just transparent. We said, we have to get some things figured out. And so we can't go hard day one, but we don't have a problem, going hard by the time due diligence expires. We're going to know one way or the other if it's a go or no go.
And did you have a typical 30-30-30 as far as your terms, or was it just a straight 30-30 as far as 30 days due diligence, 30 days to close?
It was 30. Yeah, it was 30, basically 30, 15, 15. So okay. Yep, 30 and 30.
Okay. And so that's how the first 30 days after that expired, that's when, if you guys decided to move forward, that's when $500,000 would go hard.
Correct.
And did you have to put all that money up front on day one and then just went hard at certain points?
No, we had to put, so it was a total of $1 million of earnest money. We had to put half when we went under contract. That went hard after due diligence. We had to put up another half at that point, and then that other half would go hard after another 15 days when financing would expire.
Okay. But past the 60 days, there was no extension available.
No extension, correct.
Okay. So you're putting yourself behind the 8 ball there. So
exactly.
I like it.
Yeah,
good.
Exactly.
It makes you execute, doesn't it?
No other choice. Yeah, we got to get it done.
Yeah. And we did a deal, one of our very first kind of large deals like this one we did in 2019. And it was a $51.5 million deal. And we were raising $14 million for that one. And we ended up, in order to get awarded the deal, they wanted a tight timeline for closing. And so all the 3 partners looked at each other and were like, let's do it. So it was a 30-21. So I had 51 days for our largest deal to date and largest equity raise. And we ended up closing it a day early.
Yeah.
Which was pretty exciting.
It's amazing. Yeah. When you got the pressure on, it's a good sized deal. It's amazing what type of motivation that can that can cause for sure. Yeah.
So talk to me a little bit about the financing on this deal. What'd you do from a finance perspective?
Yeah. So, like I had mentioned earlier, we were looking at either going agency, Fannie or Freddie, or doing a bridge to HUD, which we executed both strategies in the past, and we had done a lot of HUD financing, several years ago, and then we've switched to doing more agency debt. But for this project, and honestly, the other two deals that we closed earlier this year, with the debt service escrow holdbacks that the agencies are having you hold on to in the size of this deal, the equity raise, if we went agency, was pretty substantial. We're already kind of stretching what we thought that we could do if we went a little bit higher leverage. And so not only that, but when we were underwriting going agency versus going bridge to HUD, which that's eventually what we did, we were able to get better returns, not just necessarily just because of the leverage, but our return metrics were just better you going a bridge to HUD route.
So you started off with the bridge financing, and then what's the plan to hold on to the bridge loan for how many years? And then at what point are you going into the HUD financing?
We're already in the process of flipping the bridge loan out, going HUD. I mean, we would love to close on a HUD loan, but it can take 4 to 6 months to go through the process of getting a HUD 223F loan in place. And so essentially the bridge loan is literally just a short-term bridge to until we can get that HUD financing in place. And we actually started the HUD reports and third parties while we were under due diligence. Our due diligence period had expired, but we were already starting the process, getting the HUD inspectors up there to get that process started. Mostly being we just, a HUD 223F, it's a 35-year term, 35-year amortization. And we wanted to be able to lock that rate in sooner rather than later, just not knowing what interest rates are going to do in 21.
Mm-hmm. And what kind of interest rates are you getting for this HUD right now?
So I haven't seen a quote in the past week or so. When a couple months ago or month and a half ago, it was anywhere between like 2.15 to the 2.5% range. And then that's plus there's some MIP that you have to pay. We believe this is going to qualify for a green MIP, which is 25 basis points. So we're looking anywhere from, the low, 2.35 all the way to 2.75 in that range. I think we underwrote at 2.75 for the permanent financing. So
outside of the timing of I definitely have heard of it taking 4 to 6 months. What are some of the other considerations or reasons why somebody would want to go into a HUD loan versus obviously the 35-year AM is definitely a nice benefit. Yeah. What are some of the other advantages to it?
Yeah. So the 35-year AM and 35-year term are certainly attractive. And so, I mean, you don't have to ever refinance for 35 years if you choose not to. Also, you're typically are going to get a little bit lower interest rate than a Fannie Mae or Freddie Mac. Now, on the flip side, and it's a fully amortizing loan, so there's no interest only with a HUD loan. So you're not getting interest only. You do have REAC inspections that you have to submit to. There is a yearly audit. You're limited to biannual distributions on a HUD loan. And then there's also a surplus cash flow calculation with a HUD loan. So you actually have you have to maintain a certain cash balance based on, debt service, a certain reserve level before you can distribute. So there certainly are some strings attached, but the 35-year term, lower rate, 35-year amortization, we believe that on the right deal, not every deal, it's worth the headache. Oh, well, and the other benefit I did mention is with a HUD 223F, you can get all the way up to 85% of the post-stabilized value of the asset. And so essentially you're able to finance a lot of your renovations based on what your stabilized pro forma is going to be. And so you can end up financing quite a bit of your renovations through that HUD loan if you go that route. Now, we're not really doing any major renovations on this property, so it's not necessary, but that's just one other advantage. They can get the post-stabilized valuation.
So what goes through your head when you're deciding on a deal? Because you mentioned obviously some properties it doesn't really make sense for. What would be some of those properties that this type of a loan wouldn't make sense for, where you guys would maybe consider another type of financing?
Well, I mean, and to be honest, if it wasn't the environment that we're in right now, we would have definitely gone agency for this deal. I mean, it's when it's totally stabilized, you're not doing any renovation. Usually, agency is going to be the way to go. It's a little bit simpler process. There are less strings attached. You can get some interest only. Especially for a core plus or core project where you're not really doing a lot of force appreciation. You're really trying to, find efficiencies, and manage the asset a little bit better. And you're trying to take advantage of, market appreciation and market growth.
Mm-hmm.
And so, a lot of times an agency loan is going to be much more appropriate. But again, just the circumstances that we were in during COVID, that debt service escrow holdback, and also the fact that we were having issues, Fannie or Freddie weren't going to give us full leverage on the project because it only had a certain months of financials that they could use. They didn't have like a clean T3 at the time, and so they weren't really able to give us a full commitment on the project itself. And so if we wanted to go agency, our equity raise would have been nearly double than what it was.
What kind of prepayment penalties does the HUD have on it?
So that's the other drawback. There is a step down prepayment penalty that burns off. Usually it's like I believe it starts at 10% and then it burns off 1%, per year. So starting at 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Now you can, I believe, pay for an extra point or two on your interest rate to burn that off a little bit faster. And that's the conversations we're having right now. But that is the other aspect, is that you really need to be committed for a long-term hold if you're going to go HUD.
Okay. Yeah. But then after 10 years, even though it's a 35 AM, no balloon, you can still get out whenever you want.
Exactly. And it's fully assumable, prior to that prepayment burning off. But after 10 years, it's free and clear, no penalties.
How long does it take to do an assumption on one of those types of loans?
It can take a little while. We've done a few assumptions when we've done a couple co-GP deals. It can still take 4 to 6 months on the assumption.
Okay. All right. And so obviously this one's a core holding. So there's not really, like you said, any renovations or anything like that. What is the business plan for this project? I mean, is it just really just to buy it and put it in the portfolio and manage it well and hold it for 10 years and sell it?
I mean, that's part of it. I mean, the strategy behind it was a little bit more nuanced than that. I mean, the real opportunity was that since it had been in lease up, they had a significant amount of concessions that they had been giving to lease up the property and essentially buying occupancy. So they went from 70% to 94% occupancy in a period of about 2.5 months. And they'd been doing a significant amount of concessions. So a lot of the business model was, let's burn those concessions off over, not assuming that they're going to go away year 2, because 1, we're in a pandemic. 2, we just can't assume that our, we're going to be able to get the effective rent to where we want it to be. So we burned concessions off over a 4-year period, always modeling that we were going to have some degree of concessions, but really just continuing to burn those concessions off. Surprisingly, even though it is a new construction, there are several properties in the immediate submarket that are charging a higher rent than Villas on Fur. Actually, one asset that we believe is a step below Villas, they're about $200 premium over our units. And so we didn't model really any significant rent growth, but the idea would be to move rents closer to the rest of market. And additionally, since the seller, they're essentially a merchant builder, they're buying these things, leasing them up and selling them. They were just, and they're great at that and they were great to work with, but they were not the best at managing the asset once it was stabilized. I mean, they were used to just throwing money at things and having a large bloated budget because their value is when they sell it. They built it, they're getting it stabilized, but it just really needs to be stabilized. They're not really looking to run the thing as efficiently as possible so they can produce great cash flow to their investors. Their returns are all going to come from the value creation for building the asset itself. And so there are significant opportunities to just run the property more efficiently. So most of the return is coming from burning off concessions and operational efficiencies.
Mm-hmm. And what are some of those operational efficiencies that you have identified on this property?
So first was payroll. They had a very bloated payroll. They were essentially camping out a regional manager on site and charging that to the property. And so that was adding, quite a bit of expense. They had quite a few contract services and contracts they had kept on that we didn't think that were really necessary. Their marketing, I think they had a $140,000 marketing budget, which we just, but we're like, we don't know how you were able to spend that much, but it's not necessary. We just found out last week that they had like a spot on like local radio that we didn't even know about until like the radio station contacted us. So they were doing significant in marketing. We're still going to do a decent amount, but we're cutting that in half pretty easily, still able to have a healthy marketing budget. And then also their admin costs, were significantly bloated. That, isn't uncommon. And we just don't have nearly as many chargebacks and things we run through the property that a lot of other groups do.
So whenever you're doing this particular plan, obviously we talked about the bridge loan was a 2-year term bridge loan, but you're already in the process of putting on the HUD financing on here to give you the longer amortization and all the higher LTV and all the other benefits that go into what we had talked about. So when that transaction occurs where you are essentially refinancing out of the bridge into this HUD financing, first question is, does the bridge loan have a typical 12-month lockout on it? And then the second question is, when you do that type of refinance, at that point, are you still returning back some of that money to the investors? Or is that more of just like this kind of gives you some more operating reserves and cushion for that property?
So the first question, there's no lockout just because our bridge lender is also the servicer of the HUD loan and the HUD lender itself. And so they have a specific bridge to HUD program. When they underwrite the bridge loan, they underwrite the HUD loan at the same time. They plan for the takeout to make sure that the sizing is going to be of the bridge loan and the HUD loan are going to be appropriate. Because there are, a decent amount of fees for the HUD loan. They want to make sure the sizing is enough to, hopefully cover all of those additional fees. You could do a cash out with HUD. Our plan is not to. Essentially, any difference between any proceeds are going to go to paying off some of those financing fees that the lender charges and HUD charges. You can do cash out with HUD. It typically lowers your LTV. I think if you don't cash out, you can get up to 85% LTV. If you do cash out, I believe your max is 80% LTV. And there was no real need to cash out. I mean, if there was a huge value increase, obviously we would look at it. But since it's just been built, we've just purchased it. We don't expect any major appreciation over the next 4 to 6 months.
And is there any potential on this into the future to put a supplemental loan on it, or do the HUD loans not usually allow for that?
They do. I believe it's called an A7. You can put a supplemental debt on a HUD loan. There are also some debt fund options that you can essentially get a mezzanine loan for. We actually did one of those on a co-GP project we did about 2 years ago. So it is possible. It's not always as straightforward as getting a Fannie or Freddie supplemental, but it is an option.
Okay. And what about, there was something else I was going to ask you about here. So the interest rate on the HUD loan is locked in, right? It's a fixed rate.
It will be. Yeah. We haven't locked rates yet, but it will be fixed for 35 years.
Okay. All right. Good questions here. Now let's talk about how you structured the deal with your investors. So obviously it's a little bit different. It's a little unique. Obviously, during the bridge phase, you could probably do monthly or quarterly distributions, but you've already mentioned with the HUD loan that obviously you can only do that, twice a year. So it kind of changes the cash flows for those investors. So talk to us about how you actually structure the deal with your investors.
Yeah, no, absolutely. So we did, we structure as a 506B syndication or exemption. The cash flow frequency of distributions, because like you said, we are limited to biannual on our permanent financing. We didn't think that it would make the most sense to start quarterly and then switch to biannual. So we're just going to do biannual from the get-go. And we just let all of our investors know, because of the financing, it is what it is. And in most folks, once they're used to it, there's not a major issue with that. In terms of structure to investors, we try to keep things relatively simple. This was a little bit of a different process because it was such a large deal. The economies of scale were just a little bit different. Our priority was let's make a great deal to investors. We want to be certain that we can close, we can raise the capital. It's a big enough deal. We're still going to make our piece, even if our fees are lower and the terms are more favorable to investors. So what can we do to get the deal done? So we have a 8% preferred return, and then 100% of cash flow after 8% up to 10% cash on cash goes to the LP investors. So 8% pref, 100% of cash flow up to 10%, followed by a 70-30 split, 70% to the limited partners, 30% to the GP. In terms of fees, we did lower fees than normal, a 0.75% acquisition fee, 0.5% finance fee, so like a 1.25 total fee load. And then we're charging an asset management fee of 1.5%, and our property management fee, which we have a third party operator as a property manager, charging at 3%.
Okay. So let me go back to this
Yep.
structure where you have with the preferred.
Throw a lot out at you. Yeah.
No, I mean, all of it was pretty straightforward. And I'm sure some of the people that were listening to this, if this is their first time walking through some of this kind of structure, they might have to kind of, press rewind a little bit.
Yep.
And kind of go back through it. But I tracked with you the whole way. The one question I had for you on this structure is the 8% pref. So obviously I understand the 8% pref makes sense. Walk me through the extra to the 10%, because technically the way I look at that is you're technically giving 10% pref is what it looks like.
Yeah, and that is what it looks like. But the main difference is, at least the way our projects are typically structured, is that the preferred return is classified as a return on capital. So your capital balance remains the same if you're only receiving that preferred return. Any additional return after the preferred, the pref, is a return of capital. So, we're still front loading the cash flow, but you're not able to maintain your total capital account balance if we're distributing in excess of that preferred return. And so it's a way for us to pay down the pref, but also still front load returns to investors, because we did want to have a high degree of cash flow in the project. We were okay with kind of making our money on the back end. And so that was the thought process behind it.
Okay. Interesting. So at what point, so obviously when it changes from return of capital above the 8%, whenever you have returned all the capital, then it converts back to return on capital.
After the capital count has been brought to zero?
Correct.
Yeah, well, then it goes to just the straight split, and it's return on capital, because everyone's basis would be down to zero.
Interesting. I've never seen that set up in structure before. It definitely makes sense. And I know people that even do the 8%, that they'll have an 8% pref, and even that is reducing their capital accounts as well, which is a lot of newbie investors on the LP side don't really fully understand that, but it actually is reducing their preferred return every time you're doing a distribution, because it's reducing that capital account.
Exactly. Yeah.
Interesting. Thanks for that explanation.
No, sure thing.
And are you planning on any type of disposition fee or anything like that on this one, or is that fee?
No, I don't think we have a disposition fee on this project. We've had it on some other deals, but not on this one.
Okay. All right. And how did you end up raising the capital on this one? Obviously it was a 506 Bravo. So family, friends, private offering, I can accept some non-accredited investors up to 35, but mostly accredited investors on this one. So how did you go about raising the capital on it?
Correct. So, we kind of, not really even 2-track, really kind of 3-track the equity raise. We had our existing pool of investors that had invested with us on previous projects. And a concern, though, was that we had just closed on the second deal of the year, literally, weeks prior to putting this project under contract. So, we had a big concern that a lot of our investors were going to be tapped for, the next at least, quarter or several months. So, our first track was to, reach out to those investors. We do an investment webinar and go through that process. But we had also been having conversations with institutional equity groups and equity brokers, just knowing that, for some of these larger raises, if we could work with one group that we could have an alignment of interest with, we would much prefer to work with just one investor compared to working with, dozens of investors. And so we went down that route and had a lot of conversations. Couldn't really find too many groups that we had a major alignment of interest, or they were asking for really too much for us to give up. And really, we didn't mind giving up return, but it was giving up a lot of the major decision provisions and giving control of the deal up. Really wasn't going to work for us, and it really also wasn't going to work for. So we had finally found a key principal and a loan guarantor, but part of their terms were they wanted some control over the deal, and so we had to marry the two to find all the equity, but also be able to secure the debt, but keeping those two sides of the coin happy. Eventually, we did a deal with a group that we've been having conversations with for a while, tried to bring them into some of our past deals. It's a private wealth management firm based here in Indianapolis who does a lot of private placements in alternative investments, knew they had been investing in multifamily. And essentially, they were looking for a new project for their clients. And the principal of that firm, he went up to the property with us. He was interested in it. He said that he would probably invest himself. But after going up to the market, touring the property, he kind of fell in love with the deal. He thought it was really solid, a good opportunity for his clients, and made a soft commitment to bring some of his clients on board into the project. And they thought that was great. We thought that they would come in with several $1 million. It ended up their clients had a ton of appetite. And then we got a call one day basically saying, hey, how much do you have left? Can you not raise anymore? We want everything that you have. And so we went from one day having a multi-million-dollar deficit of what we had to raise to having everything raised with essentially one group.
Mm-hmm. And so how did you structure with that group to come on? Because obviously the person who has the wealth management firm probably, wants to somehow, get compensated or, be part of the deal in some form or fashion, right?
Yeah. Well, that's what we thought. We offered a piece of the deal to them to be a co-GP on the project. And they're really outstanding individual. I mean, he's basically said, I want to have full alignment of interest. I don't want to have any sort of conflicts. They charge their own asset management fee to their clients. So they are being compensated in a way, just not directly from the deal itself. But they didn't ask for any additional compensation. They didn't ask for any control provisions. And they didn't ask, for any kind of fees. Now they did kind of work with us to try to fine tune some of the fees. Our fees were a little bit higher at first. They said, this is where we'd like to see the fee levels be at. And then just some of the details of the operating agreement, just some of the legalese that they wanted to see to be comfortable. But everything that they requested was reasonable. So we essentially went along with it. And, frankly, we didn't have to give up too much, especially compared to a lot of the other more institutional groups that we're having conversations with.
And what's their name and phone number?
Yeah, right. I know. Yeah, I can give it out to you a little bit, but got to keep that one close to the chest because a little bit of a unicorn.
Yeah, well, and I will tell you that in a perfect world, obviously it would be nice to just have one investor to have to worry about instead of 100 or 200 or however many you might have inside of a large deal like that. But at the same time, I will tell you that in the beginning of COVID, we had a deal that we got under contract, and the only reason why we were able to close it was because we have over 1,000 investors that are inside of our projects. And, I know some groups that had 5 equity sources and all 5 of them dried up and they lost their hard money and the deals fell through, and we were still able to execute because we had the diversification with equity as well.
Yeah.
So it's definitely kind of on both sides. I see the advantages and the disadvantages, but especially right now with the advent of the investor portal softwares and be able to manage things and do ACH distributions. It's even if I have, 100 investors in a project, it's not that much different than, having, 5 people in the project. Except for usually when it's a 1 to 5 group, they're usually wanting, like you said, lower fees. They want to see better equity splits. They want to have control rights. And it just, to me, it doesn't make sense, So it sounds like with this equity group that you found, it's a great fit.
Yeah, no, we think so. They were great to work with. And, it was unique because, they still, all of their clients came into the deal individually, so they didn't come in through one entity. And so, in some sense, we still have a lot of the same, reporting and same relationships with the individual investors. But, it's more of one, we really need to have a big conversation. It's one point of contact. And honestly, they were just able to help out a lot of the admin and, you know very well, it's a lot of kind of herding cats near the end of a project, getting everybody to have everything executed, signed, funds in, and to be able to work with another group that's also kind of doing a lot of that work and a lot of that herding was great. But to your point, having a diversified sources of equity, I think, is absolutely important, and that's something that we're always just struggling to do, because you can never count on it for too long. I mean, people get tapped out, people change their mind, and things happen. And so, always kind of looking for that new source, that next partner, and keeping the pipeline full, I think, is absolutely critical.
Now, going back to what you said earlier on in your introduction, you mentioned that for your first 10 deals, you kind of co-GP with another group, kind of get that experience level up, get that credibility up with the brokers, but also with the sellers, which I think is a great and smart idea. Did the group that you did a lot of those co-GPs with, did they help you and participate with this deal on you? With
they did not. So I brought it to them when we were, I think we had it under contract at that point, and I said, hey guys, you want to hop on board and do this deal with us? They were already, they had actually 2 other deals under contract, and they had just closed on 2 other deals, so their bandwidth was pretty much limited. They have a fund that it was going to be the last deal in their fund, and just so the timing didn't make sense. So those guys, they're my mentors. So definitely talk through the deal with them, but they weren't necessarily in the trenches step by step. But definitely still mentors, and
that's awesome.
Process. Yeah.
Well, this is a great, big deal that you took down, Spencer. And I want to know, is there anything else that maybe happened during this acquisition process that we haven't touched on or haven't talked about that you think might be beneficial for the listeners?
There wasn't probably a one specific thing that happened. I mean, there was the biggest thing and the biggest challenge to me on the project really was just dealing with the uncertainty in those first couple weeks and trying to put all the pieces together and understanding all the different pieces and trying to paint that roadmap and trying to keep an eye on the ball and moving forward. But at the same time, in the back of my head, it's trying to also figure out, if we can't do this, what is the most politically correct, and what's the most gracious way to get out of this deal without totally ruining our reputation, because that's what it would have been. And I don't think that there was a real way to get out of the deal without really tarnishing our reputation. So I think, the biggest thing I got out of it, and I was sort of joking before we did this deal, is that I had this idea where I found out that it was easier to ask a lot of investors for $100,000 than it was for $10,000. Typically, the folks that have the $100,000 are much more open to doing a project. Somebody who only has $10,000, it may be their last $10,000 they can invest. And I just said, maybe if asking for $100,000 is easier than $10,000, I'm wondering if maybe asking for $1 million or $10 million is also easier. And it sounds crazy, but it ended up sort of being the case, just because you start working with a totally different class of investor that can write those types of checks. So that was a big learning experience, and certainly unnerving, but got to figure it out somehow.
That was actually something that I was going to ask you about. So I'm glad you brought that up about the $100,000 minimum investment, because with our group, it's always been 50,000. So it's always been 50. And I know some groups it's down to 25, and some people are at 75. And I know some people are at 100, and we just have not taken that step to go, it's $100,000 minimum.
No, I'm actually kind of glad you asked that, because we had been on the fence also. Our minimum had always been $50,000, and we wanted to experiment raising it to 100, mostly based on I had so many investors ask, all right, I want to invest, what's the minimum? And it's $50,000. Okay, I'll do 50.
Yeah.
I'm like, well, if you're just doing the minimum, why don't we just do $100,000 if that's the minimum, and then more people will do that. I don't know if we may change it back down to 50, because, there are a lot of investors out there that $100,000 it's just hard to put into one deal, and $50,000 is a much more palatable number. So we may go back down to the 50. We did it for this deal because of the size of the project. And, we wanted to, not that we have a problem with a long cap table and a lot of investors, but if we could make it smaller and a little more manageable, we wanted to see if, what the results would be. So it was a little bit of an experiment. And we're really going to have to weigh it whether we keep it at 100 or go back down to 50.
Mm-hmm. Did you ever obviously in the documents, you probably left it open. So if you wanted to bring somebody in at 50 or 75, you could, right?
Yeah, exactly. And actually the wealth management group that came in did have an investor come in for, I think it was 75,000 or so. And the way I saw it is, the whole group was coming in for a certain amount. And actually I had two other, because we did have just a group of our existing investors come into the project. Like we had two guys that, they both were going to put in 50, and I think they actually formed an LLC to do it. So the contribution was 100 total, but we try to work with both. It's just hard. And certainly you and your listeners know this, that, once you make an exception for one person, you kind of have to make exception for everybody, because you can't make an exception for one investor and another invest the full 100. They see the cap table that, hey, somebody did invest for 25 or 50, what's the deal? So try to just treat everybody the same.
Yeah, well, that definitely totally makes sense. Last two questions I have for you. It's been a great episode so far, but last two questions I have for you, and they're kind of the contrasting questions. The first question is going to be about, what did you find that was easier during this entire process that maybe in the beginning you thought was going to be a little bit more challenging?
The easiest piece, it was the equity. I thought it was going to be the biggest challenge, and it was a challenge. But I was very surprised that we were able to do it, to be honest. I mean, I told myself we didn't have an option, but when we finally got that final commitment, and that group didn't take up the whole equity stack either. I mean, they were a big portion. Well, they were about 40%. And so, but when we got that first commitment, it was just a different experience than our last two equity raises. The last two equity raises, I mean, the 2 weeks prior to closing, it was just, pounding the phone, every minute of every day, trying to raise the last, a couple $100,000. And on this project, we were fully raised with plenty of time to go. And, it was, six times, or it was 5 times basically the size of the last raise. So,
yeah. So one thing I was just thinking about while you were talking, forgive me for dreaming off a little bit, or thinking about something different. But I was thinking earlier on about your introduction again, about how you mentioned you're brought up with an entrepreneurial family. Did mom and dad or other family members invest with you on this one?
Yeah, my dad invested in the project. Yeah. And my brother actually. Yeah. Which Good. They invest in a lot of our deals. So
yeah, that's awesome. That's great.
Yeah.
Final question for you, kind of a contrasting question to that last one I just asked you. What did you find that was harder than expected that you maybe thought originally was going to be a little bit easier?
Probably, the hardest thing really and this was different, was that uncertainty in the beginning of just not knowing, because the last two deals that we did, I knew that I could, beg, borrow, or steal to get the deal done. We knew we had the guarantees in place. We had the liquidity in place. We knew that we could do it. At the beginning of this deal, we just weren't certain. There were so many unknowns, and even though we knew what the pieces were, we just didn't know how they're all going to fall in place. And they all had to kind of fall in place in the right order, because if it was kind of the wrong set, some would cancel each other out. Like if the right equity with the right loan guarantor, like it just had to all work together. And so just kind of emotionally dealing with that was a big challenge that was different from kind of the emotional roller coaster on other kind of raises and projects. So
any sleepless nights?
The first 2 weeks, there may have been a few, but at least I knew we had time. But yeah, it was definitely a stressful week or two there in the beginning.
Yeah. Well, that's awesome, Spencer. I'm congratulations on taking on such a large deal and doing it with such class. And I appreciate you coming on and sharing all this information with us here on the podcast. How can the listeners reach out to you if they want to learn more about this particular deal and maybe ask you a few more questions, or maybe want to join you on one of your future opportunities?
Yeah, sure. Absolutely. You can go to our website, graycapitalllc.com. That's probably the best place to get in touch with us. We put out a weekly newsletter covering news, data, research reports in the multifamily industry. You can send me an email directly, Spencer@graycapitalllc.com. And we actually, we did a video on this project, kind of a post-closing video, and we're going to also put together a longer video that kind of breaks the deal down in a little bit of a longer format. So you can find that on YouTube. If you search Gray Capital, you should be able to find us.
Awesome. Well, thanks again for coming on, Spencer. Looking forward to continuing to follow you as you close more deals, and hopefully maybe even in 2021 do another episode with you.
Absolutely. Really appreciate it, Dan. You have a great 2021 as well. And yeah, let's stay in touch.
Sounds great.